Welcome to Hedge Fund Tips with Tom Hayes for the week ending October 30th, 2020. This is our 54th video cast, our 44th podcast, and as we always do, we're going to kick it off with the media spots and the messages from this week. First, I'd like to thank Ellie Terrett and Liz Klayman for having me on this afternoon on Friday to discuss the volatility in the market. And the one question that Liz asked that there was a company named Mohawk Industries. They do flooring, they do housing, building products, supplies, etc. And whether this was going to be a rotation into housing, is that the safe haven? Because as we know, tech was selling off, and we're going to spend a lot of time on that today. And I said that this was not a liquidation, this was a rotation. And the reason being, if you looked at the 10-year yield today, spreads were actually going out. The yield curve was steepening. And of all things, where you saw green while tech was getting crushed was banks, regional banks, and even the money center banks were all green. The only tech stock that was up was in the big group was Google, which we'll talk a little bit about that. That's nuanced. But it was nice to see that steepening in a quote-unquote risk-off day. If it was truly a risk-off day, there would have been a flight to safety into bonds. It wasn't. It was a rotation day. And the idea was we were moving from high valuation stocks to low valuation stocks. As we start the new cycle, there are more places where you can find growth. And a great example was the stock that Liz brought up called Mohawk Industries. They beat on the top and bottom line. Earnings were up 18.5%. Sales were up 2.9%. And earnings estimates are 37% for 2021. What's interesting is with the 37% expected growth rate, the forward multiple is only 11.9 times forward earnings. How's that compare to a Facebook that's going to grow 27%, not 37%, and is trading at a 27 times forward multiple? Or an Amazon that's going to trade at 39% earnings growth rate relative to 37 for Mohawk, but it's trading at a 71 times multiple instead of an 11.9 times multiple. So managers are getting ahead of the curve here. We know historically that cyclicals outperform following elections historically for the first 6 months. They also outperform in a new cycle. So what we saw today was the yield curve steepening. We saw money moving into regional banks and energy. The last shall be first. The most hated sectors were actually getting a bid while FANG was selling off. And that was interesting. And as far as Mohawk goes, we've covered many times, 85 million millennials, housing formation. That trend is going to continue for a while. The other thing that we talked about, which we'll go into a little more on the cheddar, was that you basically, if you took the average of the 4 FANG stocks that reported in the last 24 hours, Apple, Amazon, Facebook, and Google, they trade at an average of 39 times 2021 EPS with 31% earnings growth expectations versus the S&P, which is trading at 20 times forward with 24% earnings growth expectations. So basically, if you're buying Amazon, Apple, Facebook, and Google in a basket, you're paying a 95% higher multiple for only 26% increase in earnings growth rate. So that was that. And then she came back to me at the end of the clip, and we talked about high-quality bellwethers like Raytheon, which I had talked about earlier in the week when I was on with her. And on the weakness, Greg Hayes, the CEO, bought over $3 million of stock this week. Some of his directors also wrote seven-figure checks to buy the stock. And there is just tremendous amount of opportunity out there. So definitely want to thank Ellie Terrett and Liz Klayman for having me on this afternoon. Now, earlier this morning, I was on Cheddar and with Kristen Scholler. I want to thank Kristen and Francesca Conti for inviting me on, as well as Taylor Craig and Kara Fellows for helping me out with this segment to get everything organized. And this segment was quite a long segment. Now, if you go to hedgefundtips.com and just click on Featured On, every single one of these spots will be there. And what's valuable about doing it, it's a huge time saver, because when you listen to the clip on Fox Business with Liz or with Kristen Scholler here on Chatter, you get a tremendous amount of research synthesized into a matter of minutes. It's just a huge time saver. And the goal of the Cheddar interview was to break down the earnings that happened overnight with Apple, Amazon, Google, and Facebook. And I wanted to make a couple of points. Number one, they're due for a breather. As we know, cyclicals outperform in a new cycle and after an election. Right now, they're $5.3 trillion combined market cap for these four stocks. If you think just in terms of, our GDP is just over 20 trillion. So they're like a quarter of our country's GDP, which has just been, huge, which is why the government is gunning for all of them now to break them up and bring them down to earth. The other thing, these four stocks, Apple, Amazon, Google, and Facebook, Alphabet and Facebook, are 20% of the S&P weight. You add the other FANG stocks, FANGum, you get to over 25%. Infotech as a sector is now 40% of the S&P versus 37%, its highest weight in 1999. We know what happened next. That doesn't necessarily mean that's what's going to happen now. There are some secular changes happening, but I do think we're in a position now where we're going to have some relative outperformance from the left behind laggard groups. I made a similar point with Kristen that we're moving into sectors that are going to have greater earnings growth in 2021. So if you look at the S&P, it's going to grow 24.6% earnings growth in 2021. Industrials, materials, and financials will all grow in line or greater than the growth of the S&P 500, whereas Infotech, while it's 40% of the S&P weighting, is only going to grow at half the pace of the S&P 500. So that's going to change. I think the left behind industrials, materials, defense stocks, financials are, and even energy. By the way, today energy was up. Number of energy stocks were green, and banks, while FANG was getting bludgeoned. So that's basically it. You've got some major regulatory headwinds with Google, Facebook, and some of the others. The FTC is going to make a decision at some point imminently whether they're going to pursue antitrust against Facebook. They all have a target on their back, which is going to mean, as I've said in past VideoCast podcasts, no one's ever gone before Congress to talk about antitrust and life got better for them. Just ask Microsoft. You move from offense to defense. Your focus goes from preservation to from innovation to preservation, and it impacts your margins because of all the costs and effort that go into defending yourself with the regulatory bodies and paying the lawyers. So this is a big factor. Section 230, if that liability shield is removed, number one, it's going to help them become bigger monopolies because no one in a dorm will ever be able to start another one up because they will not have the infrastructure to censor all of the tweets and or Facebook posts to make sure that they meet the new criteria set forth by the regulators. But they'll wind up breaking them up. But the sum of the parts of the new companies will be greater than the whole. It just won't look so big, just like happened with Standard Oil. But in the meantime, as that becomes more and more real, multiples will go down for the stock, margins will start to compress, and I think managers are starting to sniff that out. Obviously, there's also the potential issue of the corporate tax rate increasing next week if there was a sweep, which the market is setting up otherwise, and we're going to cover in this podcast videocast. But as far as the earnings results, listen to the interview with Kristen if you want explicit detail. The bad news on Apple was iPhone sales were down 20% year on year. Most of it from China was down 29%. But that was simply because their iPhone 12 was delayed into this quarter. Ordinarily, it's in the third quarter. So all of the non-iPhone products actually grew in China. So it's not an anti-Apple thing. It was really just the delayed release. The market didn't like that there was no forward guidance. And the other thing to think about is that all of the record Mac and iPad sales were all pulled forward because of COVID for people that have to work from home and study from home. On the good news, Tim Cook said the first 5 days of shipments for iPhone were strong and he was optimistic. Service revenues were up 16.3%. They've got 585 million paying subs around the world. And that's up 35 million quarter on quarter. And aggressive carrier subsidies should help with the iPhone 12 sales, but they have less weeks this year in the final quarter, so they really have to push that hard. And all the other categories beat the estimates, so top and bottom line beat. Amazon, the bad news was two things: that the $4 billion of estimated COVID cost in the next quarter for cleaning, paying employees more, etc. Their shipping costs were up 57% year on year, so their margins are getting hit a bit. And the most important thing in my view is the Amazon Web Services met expectations. It did not exceed expectations, unlike Google, which we'll talk about, and Azure. So it seems like those guys are starting to cut into the pie, although the pie is getting bigger. On the good news on Amazon, their sales are expected to be up 28 to 38% next quarter. Prime subscriptions were up 33% and revenues were up 37%. And of course, they beat on the top and bottom line. Google also beat on the top and bottom line. The really good news for Google was the Google Cloud. They're going to break that out in Q4. That data, which they never have, which tells us that that's growing, and they want to show the world how great their cloud business is cutting into AWS and Azure, which is a positive thing for the company. Their search engine fears did not come to bear. People were worried that search advertising and YouTube advertising was going to be down. It wasn't. It was up 6% year on year. Revenues were up 14%. EPS was up 22%. The bad news, obviously, is the DOJ has sued them on an antitrust basis, so they're going to have to prove themselves, which it's going to be very hard to prove that you don't have a monopoly in search when you're 90% of search. So that could be a situation like Microsoft. When you get your eye off the ball, Microsoft missed all of mobile while they were defending the antitrust. They've come back after. Google will come back after. But in the interim, their multiples contracted, their growth slowed, and we may very well see the same thing for Google moving forward. But it's too early to tell. Facebook beat on top and bottom lines. The real bad news is that the Apple is now going to have iOS 14, a new operating system coming out, which is going to protect the user's privacy and ruin the ability of Facebook to target aggressively, meaning if you're an advertiser, you're not going to be able to get targeted results as much as you were before because of Apple putting this new thing in place for iOS 14, in which case you're not going to be willing to pay Facebook as much because your conversions are going to drop. So that's a big headwind for Facebook. They lost 2 million daily active users in the US and Canada. It went from 198 million to 196 million. That said, world's smallest violin, they still have 2.74 billion monthly active users globally, which was up. They have the FTC antitrust risk and an imminent decision on that front. Sales were up 22%, accelerating political ad spend, and net income was up 29%. And finally, we have covered all of the tech stocks. So for more detail, click on Featured On. Go ahead and watch that with Kristen Scholler on Cheddar. That was a nice long segment, about 12 minutes. And then finally, on Monday, I was on Fox Business with Liz Clayman. Want to thank Ellie Terrett again and Liz for having me on. This was a 2-segment show. The market was vacillating between down 600 and down 900. The key worries were the EU spike ups, the shutdowns in France and potentially Italy and Germany. The market was obviously worried about the potentiality of the corporate tax rate going up from 21 to 28%. At that point, SAP had given weak revenue guidance, so people were worried that would spill over into other tech. And a lot of worry about tech, and that came to bear towards the end of the week. And the key message there and the takeaway was to buy high-quality bellwethers in the left-behind sectors. And, we talked about financials, and we talked about industrials, and moving forward on those fronts. So that was the key there. As far as the multiples, which I went into pretty extensive detail with Kristen Scholler, if you just look here on this chart that I pulled together in preparation for that interview, you look at the average PE of Apple, Amazon, Google, and Facebook over the last decade. In the case of Google and Facebook, they IPO'd later, so from inception. If you average that out, it's at 28.25 times current year earnings over the last decade. That's their average rounded multiple. Going into earnings, these four stocks were trading at about double that, a little less than double, at 51 times current year earnings and 40 times forward estimates. So, ranging anywhere from 29 times to 27 times to 71 times in the case of Amazon. And the growth rates, again, you're paying almost 50% more for a growth rate that's less than the S&P 500 on balance. In the case of Apple, in the case of Amazon, you're paying 71 times, etc. So the market is really just starting to navigate this. These are amazing franchises, but a lot of their price appreciation has been a function of multiple expansion and pulled forward earnings growth in 2020. And I think that they just take a short-term breather relative to the laggard sectors, and they'll be back. These are, effectively monopolies, and so long as they stay monopolies and aren't broken up, they'll continue to have that monopoly pricing power and advantage in the market. So thanks again to Liz Clayman and Ellie Terrett. I finally want to thank Meta Singh and Shivani Kumarasan for asking me to be in their article in Reuters a few days ago. And my quote was, "Stimulus is now pushed back to after the election, and the market's digesting that today." So that was probably a down day, and they were asking me, why is the market down? And now on to our article of the week, the Back to the Future stock market and sentiment results. This is a really interesting article. I've noticed that the setup in the market going into this election is pretty similar to the setup going into the 2016 election. And I remember in 2016, it was such an amazing opportunity. It was down 7 consecutive days in a row. People really felt like it was going through the floor. And I remember particularly the small caps, because we just did unbelievably well. And just every day they kept going down. Every day we kept adding. And as soon as the 2 days before the election, everything just turned on the dime. What would be the equivalent of Monday? We'll see if that happens or not, if it rhymes or if it matches. But they just ripped. And I think it was some ridiculous multiple, because we were doing some options on that as well into the print, and it just took off. And I'm going to show you some charts and show you how these things are setting up similarly. And, in effect, I don't know if it's setting up for just resolution or if it's setting up for upset. But either way, it's something to take good note of. And there were tremendous opportunities this week I hope you took advantage of. And maybe you'll get another bite at the apple on Monday before the hopeful results on Tuesday. So, okay, so we went through, and the concept of Back to the Future was from my Monday spot with Liz, where I told Liz this is Back to the Future. The market was just setting up like 2016, down 7 days in a row. And it really was one of the greatest opportunities to make a large amount of money in a short period of time. And I think we may be very well setting up for the exact same opportunity here. Certainly we're positioning for that, and we'll take it as it comes. So, what's interesting is that in 2016, they all bottomed the Friday before the election, November 4th. Their election was on the 8th. Ours, will, as you know, will be on the 3rd. So it'll be very interesting to see if this was a final bottom here. And based on how the 10-year Treasury was acting, you had the same type of situation in 2016. So let's just take a look at the comparisons here. Unfortunately, this is Wednesday. This would look a lot closer today. This is the S&P 500. If you look, it just sold down into that uncertainty. I'm not actually. Maybe I can pull up. Well, anyway, we're probably down closer to here as of the end of the day. I was busy this afternoon getting ready for Fox, but it's looking very much like that Friday. And this bottom line, this blue line, I thought that was, in my recollection, I thought that was election day. It wasn't. It was the Friday before, 2 days before. So we're probably down here. We have this similar type of bounce weakness here. We'll see, getting close to that 200-day moving average. I don't think we got near there, but we're knocking on the door. And then it just completely ripped once you had resolution and just didn't stop for the next 4 or 5 months, straight up. As a matter of fact, that was looks like about a 20% move in the S&P 500 in 4 months. So that's phenomenal. Not to say that's necessarily going to happen now, but JP Morgan was out with a note that said if Trump happened to upset, and they were very cautious about taking that risk. But if he did, the S&P would go up 14% to 3,900. And I think from where they said it, it's lower now, so it's probably more like 18% now to 3,900. So, but what's more important about this analogy, or comparison rather, is that then the weakness of the indices is the specific sectors and stocks that were the strongest coming out. So again, financials, this is in 2016. You can see it into the Friday before. They were trading down, weak, and then they just exploded up. Okay, so you're looking here at about a 30% move in 3 months for the total sector. Here, same thing, this type of sideways weakness into the Friday, and then boom, although we were up a little bit today on financials, but this is the same general pattern, this sideways, and then they just took off. What's really uncanny is the yield curve, okay? This is crazy how closely it's tracking this weakness, going into election, getting a little bit of speed, and then it just catapults. In the case of 2016, from about 180 bips to 260 bips, we're at about, 85 bips or something. So imagine going to 125. And over the summer, if you remember, I think the 10-year was at 52 bips. I said I would bet more money. People were saying it was going to go to 25 bips. I said I bet more money that it's going to be at 125 by the end of the year than I would that it's going to be at 25. And we're moving in that direction. Let's see if we get this type of catapult once we get resolution on the election. But that would obviously be consistent with this huge monster pop in banks and financials that maybe we started to see the hints of today. And what was the biggest pop of all the financials in 2016 is our favorite albatross, Wells Fargo, the most hated stock in the S&P 500 that we can't get enough of. And it's just been, I had to pull up this quote today. Boy, even I get pop-ups at my own website. Okay. The stock market is a device for transferring money from the impatient to the patient, and boy, have we had to be patient as hell with this. But it's interesting because look at this setup in 2016. We've been waiting here from, March to October. So 1, 2, 4, 5, 6, 6.5 months, 7 months, something like that. Well, look at what was going on in 2016. They had the crash, and then they waited from February all the way until now. We've only had to wait from March. So they're kind of like depressing, downtrend, sideways, do-nothing movement was even a month longer than ours. And then sure enough, they got to election resolution, the yield curve steepened, and it just completely catapulted here from low of 37 to 51 in a matter of 2 or 3 months. So we'll see what happens. History rhymes. It doesn't have to repeat, but all the conditions are really set up for there to be some catalyst to just, steepen the curve, have financials take off, laggards take control of leaders, the last shall be first, and see what happens. And funny enough, today also we saw energy getting a bid while Fang was getting taken out to the woodshed and shot. So, same thing happened in 2016, the Friday before, and then you got the resolution and boom. Same thing here, weakness into the election, and then, we'll see, boom. So, ExxonMobil was a good example here. It had this type of, double bottom weakness, depression movement, and sure enough, we have a similar type of situation here. We'll see if we get that type of resolution to the upside. Defense stocks, another group we love, same exact thing, this sideways lack of movement, and then all of a sudden, boom, the election, and they were up 30% in looks about 4 weeks. That's the sector. Some of the names must have been up 50, 60%. General Dynamics is a good example. It shot from 135 to 165 within 3 weeks after the election. It's setting up exactly the same thing, this sideways kind of depressing downtrend move, and then boom, resolution, and it takes off. So the last shall be first, rotation, where the stage is being set with the Fang earnings behind us, and we've seen the result of that. They have to take a breather. Now, what's interesting, which I didn't put in this article, that I figured I'd do with you right on the thing right here, is I'm going to go through, okay, so here's the Friday before election. This is a 2016 chart. Look what was happening at the same time. General Dynamics, Wells Fargo, defense stocks, financial stocks, energy stocks were just going bananas and spiking 30, 50% in weeks. Guess what was happening to tech right into the election? Boom, they took a breather. They bounced down to their 200-day moving average, and they stayed there for months. While the laggards were exploding, the leaders were taking a rest after that election. There was an abrupt, massive rotation during that period. And then, 3-4 months later, everyone said, well, their earnings are good. Their multiples are now normal. You had new earnings to look forward to. So you weren't playing off of the 2016. You were playing off, and 2017, you were playing off 2017 and 18. And they just took off. So they had their multiples became more reasonable, and they continued their uptrend. And I think we could see a similar situation right now. I know there are some major names calling for the end of the world for tech. I don't know the answer to that, but I think they're pretty durable here, and I think they're just due for a pretty healthy rest. So that was Facebook in 2016. Let's look at Amazon, see if that one also rested after the election. Sure enough, exactly the same pattern. Rested for a few months before continuing its uptrend. Here was the Friday before the election, and boom, down to the 200-day and stayed there for a few months. Facebook, Amazon, Apple. Let's take a look at that. Okay, same exact thing. Okay, it rolled over back down to its 200-day, and then it resumed the uptrend after taking a rest. And I think that's a reasonable outlook. And let's see, I guess Google will take a quick look at. All right. Yep, same exact pattern. Down to the 200-day for a couple months, and then it resumed its uptrend. So, that could be a nice short-term rotation and really bring these laggard stocks to bear, and then the tech will join it, and that's what you want. You want wide breadth for this next phase of the secular bull market moving forward. So our focus has been banks, defense stocks, and pockets of energy at the margin on any down days this week, which we did pretty much every down day. And the other thing, that's uncanny with regard to this analogy, the same or similar stock sectors and stocks showing weakness into the election and then spiking versus showing strength and then falling, is the betting odds for the presidency. In other words, the sectors that are currently weak, anticipating a Biden or in 2016 Clinton presidency, are the same ones that immediately exploded and may explode after the election. We'll see higher, moving into Q1 2017 and what will be Q1 2021. So what's interesting about that is President Trump's poll numbers haven't been this bad since the night he won the election in 2016. Now, you could say this is different because it's a much tighter race now. But no one knows. That's really what it comes down to. And it certainly doesn't mean that bad polls equals good election results. I'm sure as hell he would rather be winning in the polls, or what he would call the fake polls, than be as tight as they are. So, but we're not political commentators. We're market participants, so we have to be prepared for every eventuality, which is why we're looking at historic situations to give us an idea of all the different possibilities that could happen, and what things would look like if, in fact, there was a surprise on Tuesday. So the other issue about this is, if you looking at the charts we just went through and the related fundamental factors we've covered ad infinitum in the past 4 to 8 weeks on these podcasts and videocasts, these sectors and stocks are set up for a major rally off of extremely depressed and oversold levels, irrespective of whether there was an election or not. And what makes it interesting is that if you think about the consensus or priced in or blue wave outcome, it just doesn't sync with these stocks and sectors rallying off the lows. So it implies, like, if we took the election filter off, we could clearly make the case that many of these stocks and sectors are due for a major bounce and or rotation. But if there was a blue wave outcome, that would be like extremely unlikely. So it seems like the way things are set up is that the consensus is not going to be right. Now, I don't know if that means a Biden presidency and the Republicans hold the Senate, in which case the corporate tax rate would not go up and it would be bullish. Or if you'd have a Trump presidency and maybe they lose the Senate, the Democrats take the Senate, Democrats take the House, or Trump and they keep the Senate, or who knows, a red wave, which is very low probability, but would be less bullish than a mixed situation. Historically, the most bullish thing is gridlock. So you either want Biden and a Republican Senate, or Trump with a Republican House, with a Democratic House. Some checks and balances. That's historically when the market outperforms. Blue waves are not bullish. Red waves are not bullish as well. Not as bullish as having the mix. So we'll see. But the way this market is setting up, and who the hell knows, but it does not seem like a blue wave. It seems like some mixed outcome, irrespective of who wins the presidency. So what does this tell us? Maybe nothing and maybe everything. Meaning, if these stocks and sectors are set up to bounce and rally, and a blue wave would have the opposite effect on these particular stocks and sectors, perhaps it's presumptive to expect a blue wave. JP Morgan put out a similar note this week showing the election betting odds, which, they're showing the predicted. We showed the electionbettingodds.com numbers from 2016 and 2020 in August. But the theme is the same. And the theme is his odds are much higher at this exact point in 2020 than they were at this exact point in 2016. He was down close in the low teens, and now he's in the mid to maybe high 40s since this was printed. I think he's picked up a couple of points. Another note that we've spent a lot of time on over the summer is about Kanye West. Everyone underestimates him. No one talks about him. But he's on 12 ballots, a couple of which are swing states, Minnesota and Colorado, where 5 or 10,000 votes really make all of the difference. The other thing that I've noticed is, because I follow him on Twitter, is that first and foremost, you need to know he didn't become a billionaire selling sneakers because no one likes him and no one listens to him. In effect, the opposite is 100% true. A lot of people like him. A lot of people follow him. And, selling a commodity product like sneakers and becoming a billionaire when it's not even your own company goes to show the influence he has. And then I started to think in my mind, like, he's got 30.9 million followers on Twitter. I haven't looked at Instagram because I'm not a big Instagram person, but I'll bet he's got a lot more than Joe Biden on Instagram as well. But he's got, Biden's got 11.6 million. Kanye West has got 30.9, and President Trump has 87.3. So the idea that Kanye is not going to be a factor, particularly when you saw in the last few days, he tweeted his 30 million people and 36,000 people liked it and a few thousand people retweeted it. He said, right in Kanye West. So, and he shows someone writing in Kanye West at the bottom of the ballot. So everyone's focused on the 12 states where he is on the ballot, but I have to assume that quite a few people who are going to go vote for Kanye West are people that may not vote generally and are going to exercise their vote. And it doesn't make a difference to them if they have to write his name in because that's what he told them to do, or if there happens to be a place where they can fill in the circle next to the name Kanye West. So I'm curious what impact, if you have 2,000 write-ins in a state like Philadelphia, who knows? Trump's gotten a lot of new endorsements in the last couple of days that could be influential. But I just, when I just thought about the following of Kanye West, and then I saw that tweet where he shows people with a video how to write in the name Kanye West. I said this race is going to be really interesting, and I think that it's going to be as important as I've been saying since I think July, and really no one has spent much time on it at all. JP Morgan did a similar study to the one that I'm talking about. Which sectors did best immediately following the Trump victory? The summary is that financials did the best, and consumer staples and tech did the worst. So you can see the charts here. This was the ratio. Let's see, S&P 500. It took off. It was weak into the election, then it took off, and then financials you see here just went parabolic. Tech was just weak again. It went down to that 200-day line. We went through all those. Industrials went almost parabolic. Value versus growth. Value went almost parabolic. And consumer staples sold off like tech. So that's a defensive stock. So we'll see. I mean, that's what the setup looks exactly the same. Now we have to see the outcome if we get the similar results. Jeffrey Gundlach, who predicted Trump's victory in 2016, is predicting the same outcome in 2020. Good luck. I mean, that was a bold call in 2016. I think it's still a bold call, and we'll see if he's right twice. Or if lightning strikes twice, I guess is the way to put it. So, the other aspect of this is tech's underperformance would be harder to fathom in the event of a blue wave. And this falls in line with the recent overhang of Section 230, the liability protection that they currently enjoy. And so this idea of tech taking a 2-month rest while these left behind sectors exploded out of the election finality is perfectly in line with the theme of the Justice Department being all over these guys right now and gals in the big FANG stocks. So that it's just consistent with how this played out and how that seems to be playing out right now. SocGen had another thing saying that tech's price relative to the overall market has improved, but its earnings per share estimates relative to the overall market had started to drop. And I just put it in a simpler term. I said, to put it more simply, Infotech is expected to grow earnings at approximately half as fast as the S&P 500 in 2021. In other words, the pitch for buying tech today is, buy now, you can have half the growth rate for nearly 2 times the price. Just pay processing and handling. So that's where it is. There was another chart here showing that in 99, tech was 37%. The value of market cap in tech was 37% of GDP, U.S. nominal GDP, versus now it's 42% of nominal GDP. The Wall Street Journal said it was 40%, but ballpark. Bottom line, it's higher, and it did revert to the mean in 2000. We're going to see if we get this hard rotation or just a short-term rotation, but I think rotation is the key, and today was rotation, not liquidation, as I said on Liz's show. Okay, sentiment was surprisingly high this week with the AAII sentiment survey result. It was at 35. 40 would be an extreme, so that's unusual. Fear and greed came down, obviously below 40. That made sense. And active managers cut their equity exposure, which they always do after the weakness. So the point that we've made over and over is don't bet against science. We've had some major developments, and I think the biggest one that wasn't really talked about this week was that the Regeneron cocktail that President Trump took, where he said he just turned around overnight in 24 hours and felt stronger than ever, Wednesday said its experimental cocktails, quote, significantly reduced novel coronavirus levels and the need for further medical attention, including hospitalizations and emergency room visits, and more people enrolled in its late-stage trial. We continue to see the strongest effects in patients who are most at risk for poor outcomes due to high viral load, ineffective antibody immune response at baseline, or pre-existing risk factors. So basically it's saying, if you're toast, this thing can bring you back from the dead. And it's late stage, and it's really good. And ironically, I wouldn't be surprised to see something definitive come out November 4th. But hopefully sooner is better. I mean, but this is the game changer. Like, this for me is 100 times more valuable than a vaccine, because vaccine is a whole process. Like, once people know that there's a clear and crisp cure, a treatment, and whether that's remdesivir becoming a breathable that you can take outside the hospital, or this Regeneron, because everyone knows how well it worked for President Trump, albeit anecdotal, there were a lot of comorbidities, existing there where people weren't so sure when he was diagnosed how it was going to go, and this thing just turned the tide on everything. So that's a very positive result. If the setups above are correct, we could see a number of left for dead stocks and sectors take on a brand new life in a short period of time. That's what we're betting on. And like 2016, I think the election jitters and short-term volatility will prove to be a major opportunity this week, which it was, versus something to fear. Time will tell. You can never be 100% sure. You can just take statistically advantaged positions and manage your risk. So that's that. Furthermore, this week, the unusual options activity were again concentrated in these left for dead. So big institutions are coming in and buying them out, long dated exposure. Well, in the case of BP, it was short dated. They bought 12,000 contracts. That's an energy stock. ExxonMobil, they bought out to June, 1,200 contracts. Boeing was a big print today, 2,000 contracts for May. Raytheon, which has shown a lot of insider buying as well, 4,600 contracts out to January 2022. I think that one's going to be a home run for whoever bought that. And then this week you saw millions of insider buying in Raytheon after I talked about it on Fox Business. Gregory Hayes came in and bought over $3 million of stock with his own checkbook. He is the CEO, and a couple directors wrote 7-figure checks for stock for their own personal accounts as well. That was good to see. 86% beat rate on the earnings this quarter so far, which is just phenomenal. 81% beat rate on positive upside on revenues, and that would be the highest percentage of S&P companies reporting positive EPS surprise since FactSet began tracking this metric in 2018. Estimates for 2021 this week, I looked at them earlier. I believe they went up again, which would be pretty good. They've been hovering around 165 for a while, and they are now at 167. So they're up yet again. They continue to take estimates up, as we've covered ad infinitum. Industrials, consumer discretionary, materials, and financials are all going to grow the fastest, in line with the S&P or greater, whereas infotech is going to grow at a much slower rate along with healthcare. That has not been the case in past years. It looks like it's going to be the case in future years, and we're positioning accordingly. So let's look at some economic data that came in this week. Michigan consumer sentiment beat expectations at 81.8. So all the Michigan numbers were good. Chicago PMI was strong, 61, beat expectations of 58. Personal spending was up, as was personal income. Those are two good beats that we saw this morning. Let's see. Pending home sales were down a little bit. So they they were surprising miss yesterday. However, I mean, most people are probably not going to buy a home the week before or right before an election. For a lot of people, they think that matters. But we'll see if that's a one-off because of the election jitters or if it's a real thing. Keep in mind the stock market was weak in September, so that may have allayed some people from making the jump, but we'll see. Jobless claims crushed expectations. They were expecting 775. It was only 751. Continuing claims remained subdued. It missed expectations, but it was down material off the last print of 8.4 million. It was only at 7.7. GDP, obviously record number, 33.1% GDP growth in Q3. What else did we see here this week? We had a big build in crude inventories. This was the first big build. This was disappointing to see. We'll see if it's a one-off or it persists. But you did have Russia out, and you had some others out from OPEC talking about, if you recall, their multi-year cut commitment was to cliff off in January from 7.7 million barrels a day cuts down to 5.7 million barrels a day cuts. Kuwait said today they'll go along with whatever the big boys say. My sense is they're going to extend the 7.7 after January. This will sop up some of these short-term builds, and we'll see. But, last week we covered the China demand picking up and really accelerating, so I think this is going to be a one-off, and we're going to find ourselves next week back to a draw, which we've had pretty much every single week since June when we put out the Rystad data, which we've talked about many times. Okay, other important goods orders were solid. Durable goods were solid. Durable goods beat big, so that was very positive to see. 1.9% versus 40 bips last print, 50 bips expectations. And again, new home sales were a little bit softer than expected. Same with pending, and I think that's just based on the seasonality, the climate, the election, and what the stock market was doing. That should probably come back once we have some finality with the election result, however it plays out, and we can get back to business. And then earnings, we basically gone through it, but across the board, they were just tremendously strong. We went through some of the nuances with big tech, but you just see as we scroll through, it's all green. So with that said, we are going to wind this one up for this week. We'll be back next week, same time, same place, with a lot more information. With the election is the most important data point in the next 7 days, in case you didn't know. And wishing everyone a happy Halloween. If you have little ones, we're going to get out and try to do some trick-or-treating and make it a great one.